Joining me in studio, Philip Straehl is the Chief Investment Officer of Americas at Morningstar Wealth. Philip, great to see you again.
Good to see you.
So when we were talking at your guys' conference, you had a few great stats for us. One was that we were rarely this expensive going into a cut cycle, like the top decile evaluations, and then also that the AI stuff was starting to fragment. So it seems like some of this is coming to fruition here.
That's true. I think we have seen some of the pullback, and the statistic that we looked at was looking at the U.S. market, credit markets, both high yield and investment grade, and basically all three markets, even today, trade in the top decile. And so I think what we've seen over the past couple of weeks is just a broadening of the market narrative, and we've also just seen some of the I think frothiness and maybe that momentum trade that has sort of embedded in some of those top stocks unwind in recent weeks.
How much of that is just valuation just needed to happen, when sentiment turns? It's impossible to know. How much is it really earnings, though, showing us that we're not maybe getting as much for the investment that these companies are spending into some of this stuff?
Yeah, I think it's probably a combination of both. If you just look at some of the speed and also kind of the size of the moves on the day of for example when the Russell 2000 outperformed, there seems to have been a technical element to it, so it's not purely based off of fundamentals. But I think markets are great at pricing in current narratives, current news, and of course the news for many months was on AI, and that was really sort of been driving markets. And of course with the election outcomes sort of and those probabilities changing, that has impacted markets. And of course, we also had a great CPI report that has really given folks confidence that maybe the economic recovery and a rebalancing of the economy was more constructive than what people thought.
How far does that go in justifying the small cap move? Because this, obviously, to your point, really started when the CPI hit. The rest of our economic data, though, generally has been pretty soft. Housing seems to be softening quite a bit. We got a few decent prints in the last week with like retail sales. But are those cuts getting priced in now? The degree of certainty, is that enough to justify a small cap rally, or do you have to have the economy kick back into gear too?
Yeah, I think you do need some support, I think, on the fundamental side. Of course, we will see, the market is looking for growth in the Russell 2000 in terms of earnings this quarter, and we think that will likely come through. But yes, I think broadly speaking, ultimately fundamentals will have to come in and support valuations. We take a long-term approach at Morningstar. We try to forecast cash flows out for multiple years, and if we do our analysis on large caps versus small caps today, our expectation is over the next 5 to 10 years that small caps will outperform large caps by about 3 to 4%. And so, it's not necessarily a story about the next quarter. Even if you take a long-term perspective, we do think, small caps have been lagging in recent months and recent years. And
years.
There's room for them to catch up.
And is that a valuation element? When you mentioned cash flows before that, is that also kind of a fundamental balance sheet argument about the outperformance as well, or is that just kind of a pure valuation imbalance that just has to get rebalanced?
I think it's a combination of both. Of course, when you do forward-looking valuation analysis, you have to come up with a forecast of growth, a forecast of margin. And so if we take a forward-looking view on small caps, that includes an element of where we think cash flows are going to go, as well as where current valuations are. And so, small caps if you look at it from a historical standpoint, it's not a screaming buy at this stage. But it's just that they're much less overvalued than large caps are. And I think the challenge that many capital allocators face today is you look at an S&P 500 at the large cap market that's so concentrated. And when you're taking profit somewhere, you used to be able to go ahead and buy, kind of an index fund that gave you diversification. Now you have to look at other parts of the market, like small caps, like other areas.
Because the index doesn't give you that right now.
The index does not give you that right now.
Maybe a few more days like this. Dispersion's kind of coming down a little bit rather. Correlation's kind of coming up a little bit. So maybe it'll start to normalize somewhat. We need to clear out to get out of that highly concentrated kind of .com style, deep concentration.
I think that's true. I think we have some ways to go until we kind of get back to kind of more normal levels, I think, in terms of that concentration. But I do think that normalization we've seen in recent weeks is healthy ultimately for the structure of the market.
Thinking about the small cap trade, the rotation trade in general, one thing that seems to be still unanswered about our cycle, which has been a bizarre one, which is that right now, generally, when you get the bull steepening in the bond curve like we've been getting, the Fed has to cut to kind of help the economy to come to its aid. It's usually when the recession kicks in. Correct me if I'm wrong. Doesn't the history tell us that the small caps like power out of the recession? Do we have to have like a clearing out of the economic froth first? Do you have to have the reset of the cycle? Or is it possible that maybe we don't need to have a big cliff here at this juncture?
I think it really comes down to what's going to happen to the economy, whether we have a recession or not. But it seems like if we have a soft landing, I think there's a chance that that can provide a catalyst. It's true that small caps tend to be more cyclical. They tend to be more sensitive to the economic.
So if we do have a cliff, tech, could that outperform again, or is the market so skewed at this point that just selling of stocks is going to drag tech more, by fact?
Look, we don't, in our analysis, I think tech stocks are looking expensive. What exactly the catalyst is difficult to say. I think if you look at, recent earnings and recent, market moves, it looks like expectations are so high that even, sort of a decent earnings report from Alphabet, for example, you still see the stock. You still see the stock sell off. You've seen similar, moves in semiconductors, a couple of weeks ago in the earnings season. So it seems like the bar is just set really high at this stage with earnings expectations with big tech stocks.
Okay. Phil, great conversation, great to catch up, and a very timely discussion in our last conversation. Really good assessment, some warnings that you put out there for us on the instability, the unsustainable nature of the concentration. So good stuff. Thank you very much.
Thanks, Oliver.
Absolutely. Phil Straehl, the Chief Investment Officer of Americas at Morningstar Wealth.